Today on the Altimetry Authority show, we're going to talk about one of the most important concepts in finance, in economics, the Laffer Curve, and why it's one of the reasons we're still bullish, very bullish on the U.S. economy, U.S. stock market, with the tax cuts that have been talking about, especially in light of the tariffs and how they play together.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
hit it with Wall Street. It's 2.5x
because their compensation goes up.
Wall Street's wrong again.
The Laffer Curve may be one of the most important economic topics for understanding what's going to happen to the U.S. economy and the U.S. stock market in the next year, 2 or 3 years, and yet we're not hearing the media cover it. The mainstream media seems to be bearing it. Basically, what we're talking about is the tax cuts that came through in the big, beautiful bill, and another one that's been talked about and may come in the next year. The taxes are one, the $15 billion reduction in consumers not having to pay tips, taxes on tips. That means they'll have $15 billion more to spend. Overtime taxes, that's about $85 billion. So now we're at $100 billion of more consumer spending, and that's coming through not having to pay taxes on tips or overtime. And third is about $100 billion on Social Security taxes. So that's $200 billion. Now I'm going to mention one more because it's important to mention, because they talked about it, but it got, it did get pushed in the big, beautiful bill, and it was everyone making $150,000 or less in the United States, AGI, adjusted gross income, paying zero federal tax. That will be another $350 billion. If it goes through, another $350 billion. I think it will. I think at least it'll be put up to go through. But even if not, we still have that $200 billion that's sort of in the bag in terms of more money in consumers' pockets. And what will this do? Well, we have to talk about the Laffer Curve. Now, it's unfortunate that Art Laffer, he should have won a Nobel Prize for this. He really should have, but it's been such a political hot potato because, a lot of politicians want to just keep increasing taxes to infinite levels, so they don't like that Laffer is there telling people, hey, wait a second. If you have zero tax rate, you're going to collect zero tax revenue. Of course. But he said, now you increase that tax rate even a little bit, and you will massively increase tax revenue, obviously from zero. But there is a point somewhere between, 40 to 60%, 40 to 50%, where if you continue to increase taxes, people stop working, either because they literally stop working or they just move, and so you don't get the benefit of their work. They move out of, California or New York or countries like China. They get overly taxed. Russia, they're overly taxed. And tax revenue falls. They stop hiring. It hurts the economy. There is a point where tax rates get too high, and this happens. And if you're at that level, then the right thing to do, and we were at that level post-World War I. That was 1917 to 1921, 22, 1930s. The Great Depression was not because of tariffs. I'm sorry if you've heard that from mainstream media. It is absolutely wrong. Thomas Sowell, S-O-W-E-L-L, one of the probably top 3 economists in all of history, Thomas Sowell, and he said no, in the 1930s, yes, tariffs were not good, but no, it was the giant increase in tax rate to over 70% under the Eat the Rich campaign under FDR. That is what caused the Great Depression, because when you're taxed at 70-something%, and let me throw in another, California 13% on top of that, when you're taxed at 80+%, you know what you do? You stop working or you move. It's one or the other. And that's exactly what happened in the 1930s. Also, the 1970s, people say, it was all about inflation. Inflation was the problem. Inflation was a problem. But the real problem was that administration raised taxes again to over 70%. And whenever that happens, people stop being entrepreneurs. They stop trying so hard. They stop as soon as they hit their tax bracket, and they just quit. And that affects everybody that they might have hired, all the innovation that might have happened and whatever. We've seen it over and over again, and we see it country by country also. Now, major tax rate reductions, just proving the Laffer Curve exists. In the 1920s, the administration said, all right, we don't need these high tax rates from World War I. We're going to lower the tax rates. And the roaring 20s resulted. They brought tax rates down. People said, oh, well, I'll work more if you're not going to tax me so much. As Laffer said, whatever you tax, cigarettes, gasoline, you name it, people do less or use less of that thing. Well, if you tax work, people work less. Of course they do. But in the 1920s, they brought down the tax rate. And in so doing, the economy boomed, they increased tax revenue, and they increased the share of taxes paid by the wealthy. This is an important point. Because the economy grew so much, yes, more people paid more taxes because they were all making more money, but the wealthy paid a bigger share of that, but they didn't mind paying a bigger share because they were making the profits for that. And guess what? That happened again in the 1960s. This is Kennedy. Kennedy, before he was assassinated, put through a tax cut. He said, these tax rates are still kind of high, going all the way back to World War II, where they were jacked up to raise money for World War II. And he said, I'm going to bring them down. Now, he didn't get to see the results of it, but guess what the results were in the 1960s because of what Kennedy did? An increased economy, increased tax revenue on a lower tax rate. You lower the tax rate, a few years later, the economy has expanded so much, people are making more money, companies are making more money, and they pay more in taxes. Reagan did it again in the 1980s because he was reversing what happened in the 1970s on the Carter administration. And what happened? The exact same thing. My goodness, there is so much good evidence on this around the planet, not just the United States, but if we're talking about the U.S., let's look at the U.S. alone. Over the last 150 years, we have more than enough examples of what happens. In 2000s, under George Bush, he lowered the tax rates. He did. And what happened? The same thing. Well, now we have Trump. And we have an example of what Trump did. In 2018, Trump said, I've got a problem with the corporate tax rate. Because the United States has this evil thing called double taxation, where the company pays a tax rate, and then when the money gets distributed to shareholders, this is a non-value added thing. Nothing happens between that tax paid and the person getting the money. They just get paid money, and then the person has to pay capital gains or dividends tax on top of that. In many cases, right, if they don't hold for a long time, a short-term capital gain, which means it's a very high tax rate. So this double taxation, she said, we've got to drop this. But he said, even if we didn't have double taxation, I can see there's something wrong, which is companies are not paying any more in taxes in 2018 than they were in 2000, about $200 billion. Corporate income tax in the U.S. was about $200 billion. That was what they contributed to the U.S. government. And by 2018, it was again $200 billion. Right? Now people are saying, oh, Trump's corporate tax cut it resulted in less tax revenue. And it was, I'm like, did they look at the numbers? Now, of course, right, he was looking at the highest, 39.5% is what companies were paying. That's the highest corporate tax rate on planet Earth, with the exception of two very, very small areas, right, of the world. Very, very small. So for any major country, it was 39.5. So what did that do? Companies said, well, I don't want to build in the U.S. I don't want to grow in the U.S. I don't want to expand in the U.S., right, because you're charging me so much in tax. And then when the dividends, right, are distributed or someone has capital gains in their stock, then they pay tax again, right, for no reason. So we have an evil, double taxation issue on companies. But what happened when they lowered the corporate tax rate? Of course, for a couple of years, you did not have an immediate increase. The New York Times said that Art Laffer was laughable, and it doesn't make sense. Well, I didn't see them retract that 2 years later or 3 years later when, even despite the pandemic, corporate taxes paid in, just like happened in the 1920s, the 1960s, the 1980s, and the 2000s, increased as earnings went through the roof. Yes, dividends increased, share buybacks increased, but so did hiring, so did capital expenditure, so did expansion, right? To the point that we're looking at 2024, 2025, somewhere like $600 billion, maybe $550 billion, meaning almost a tripling of a tax revenue that had been stagnant for 18 plus years at around $200 billion, suddenly skyrocketed to $500 to $600 billion. That is money going in to reduce deficits, to reduce debt, to reduce all kinds of things paid by corporations, but it was paid not because they increased the tax rate, but because it was lowered. And when it lowered, companies paid more taxes. By the way, did they only spend the money on dividends and share buybacks? No. Corporate R&D rose by 30%, including 2020's pandemic year, meaning over the course of just 4 years, it rose by 30%. Capital expenditures increased by 20-something%. GDP did not expand by 30% in that time frame, right? It certainly didn't. 2020 was a bad year.
You could argue that, I mean, this is part of what catalyzed the idea of everything that we've talked about for the supply chain supercycle and everything that we've seen that has been a ramp up in corporate investment, right? That, I mean, we've talked before, 3 to 4% a year private, right? Corporate investment in hard assets in 2000 to 2020. But after 2019, 2020, we've seen a pretty significant inflection. And some of that has been because people wanted to rebuild supply chains and then obviously investing in AI. But you got to argue some of it is because they said, hey, the math now makes more sense for us to invest in the United States than it did before. And so we're going to. And that's kind of what we're seeing in a bunch of other places too.
Now, because of this, this proves the Laffer Curve is right. When you start with a too high tax rate, which stunts growth, you reduce the tax rate to something more reasonable, which I think it's still too high because of the double taxation. Right? Because of the double taxation where corporates are paying taxes and then we still, on dividends or capital gains, are paying taxes again. We're like, wait a second, did we already pay taxes on this? Didn't the company pay? There was no value added. Why is the government taxing us twice? So it's still too high. But this was brought down. It resulted in a boom in corporate earnings like crazy. It did, and it resulted in tax savings that got reinvested into growing companies. And this is one of the reasons the U.S. has done so well since 2018. It's because of this. It really is. So Trump gave Laffer the President Medal of Honor. He should have won the Nobel Prize. Well, they call it the Nobel Prize in Economics, but Nobel never would have agreed to a Nobel Prize in Economics. He specifically said we should never give away a Nobel Prize in finance or economics fields. But, the powers that be wanted to name it after Nobel, so they created one anyway, even though he'd be rolling in his grave angry about it. Either way, whatever the top prize in economics is, Art Laffer deserves it because he was right, and unfortunately it's not popular because so many politicians just want to tax and tax and tax, not realizing if you lower tax rates, you increase the economy when they're coming from too high tax rates, and honestly, they're still too high in the United States right now. They are, right? So anyway, when you have this problem over taxation and you switch to lower taxes, you increase work, you increase business activity, you increase wages, you increase employment, and tax revenue increases. And now we're looking at 2026, and under the tax cuts that are being talked about and being put through already, and the additional tax cuts, we ought to see a dividend not 3 months later or 6 months later, but we ought to see the result of that in the next year, in the next 2 years. And if Trump puts through that last bit, the $150,000, no federal taxes at all, right? This is not a tax cut for the rich. This is a tax cut for Americans making less than $150,000. No federal tax. That is that much more money in your pocket. That's about $550 billion total that would be going into consumer spending or consumers investing, which I hope they do, and all kinds of other things, right? That would not result in a deficit, because people say it'll be increased in deficit, because if you look at the numbers that are coming in from the tariffs are sufficient to pay for these tax cuts. They are. And so you can have a non-deficit big tax cut that then results later in an increased economy, more tax revenue on that tax cut, right? And it works with people the same as it works with companies, and we have good things ahead. So that's one reason we're still big on the SPY. There's one company that we thought we'd talk about because it kind of brings these two concepts together of taxes and tariffs. Ollie's Bargain Outlet. And Rob, I'll just show the as reported numbers are showing these lower returns. In reality, Ollie's has said they had a great 2021, but other than that, they've had a good 12 to 15% return on assets. That's their earning power. If we look what the analysts are pricing in, they're saying, oh, that's going to hold the same, right? And we look at the markets looking at it, they're saying, yeah, maybe it'll improve a little bit. The interesting thing is Ollie's Bargain Outlet, which is a lot smaller than like a Burlington's, a lot smaller than like a TJ Maxx, and yet hitting that same kind of price point should benefit, one, from consumers having a lot more spending, particularly consumers who will have more money, consumers who rely on tips, consumers who rely on overtime for their pay, and Social Security, right? And so we're talking about bargain shopping in this manner. We're also talking about quite a lower income. Everyone below $150,000 maybe next year not paying tax. That hasn't gone through yet, but it may if tariffs are sufficient to cover it. That's what we think Bessent's looking at. But more importantly, this company also, because I mentioned tariffs are being used to pay for it, this company has maybe, I don't know, of its 20% of imported goods that Ollie's has, maybe 80% of that comes from China. In other words, less than 20, probably less than 15% of Ollie's goods sold are affected by tariffs coming from China, and yet everything they sell would benefit from consumers having another 200, 300, or who knows, maybe in $550 billion. So we already think it's kind of interesting. This is not an official recommendation right now from us. It just looked really interesting. It's early in our kind of watch list of let's see what's happening.
And everybody, for context, right, which is what's interesting about Ollie's is, they've had, pretty stable return on assets the last 3 years or so in the face of a pretty tough environment for consumers. And they're one of the few retail chains who's been able to grow. I think the numbers, Joel, it's something like 350 or 400 stores 5 years ago to like 550 stores today. And so everybody, they're actually...
No, I think it's higher. It's a lot. Yeah, it's a lot higher than that. I think they're getting on 900 plus stores, but they're still announcing increasing their rate of store growth, not decreasing it, because they're finding a real interesting spot for consumers.
And so everybody, right, when we look at that, right, what the market's really pricing in here is, some of that store growth. And we just think that, if the consumer's doing healthier, they're going to benefit from not just store growth, but also they're going to benefit from, right, higher tickets in terms of number of things that people are buying from their stores too. And all that, to Joel's point, makes this look really interesting in a world where, Joel, one of the things that I think is interesting when you talk about the Laffer Curve is it's almost like... it's good that we talk about the idea of it's somewhere between 35 and 65% or 40 and 60% in terms of what the sweet spot is, because it does matter, right? Everybody, for context, if you've got a country where you have high services and people feel like they get a lot of value out of what the government does for them, that number is probably a little higher. But you've got a country like let's say Russia, where nobody feels like they get any value from the services, or actually Italy is a great example of this, right? Where people feel like the government never actually works for them, so nobody wants to pay taxes. So then the Laffer curve is even lower for them in terms of where you hit that critical point. But everybody, this is the whole entire point, right? When you move that Laffer curve, that's what gets you in a good position to keep the economy growing and keep stocks growing and keep earnings growing. And everybody, so that's this episode of Altimetry Authority. If you want to hear more about a topic like this, or maybe you want to debate Joel and I about whether or not the Laffer curve is real, feel free to drop it in the comments and hit the like and subscribe button and come back next time. That's this episode of Altimetry Authority. Thanks, everybody.